Real estate investment trusts or REITs is the next sunrise opportunity for the real estate sector, given its potential to raise billions of dollars for the cash-strapped industry. The government's recent budget proposals, though good, have left the sector a tad confused. Experts and developers say that the government should do more to clarify several critical matters, like improving tax efficiency, waiving off stamp duty, and tweaking rules to make it attractive for investors. Nikhil Narayan Sivadas reports.
The union budget this year may have disappointed the real estate sector, but when it comes to its long-standing demand for more clarity on rules for real estate investment trusts or REITs, the result has been a mixed bag.
And we were expecting the budget to sort of sort out typically all the issues that REITs are facing today, for which the investors could actually go out and look at an alternative asset class quite like a REIT. But unfortunately, that hasn't happened.
Experts say the finance minister has given clarity on a few issues, like the exemption of sponsor units from capital gains tax, bringing it on par with an IPO. Pass-through on rental income has also been allowed. However, industry experts say much still needs to be done. Among the list of demands are a one-time waiver of stamp duty on transfer of assets to REITs by states, the tweaking of IRD investment regulations to allow insurers to invest in REITs, which could widen the investor base, and most critically, tax SOPs on minimum alternate tax and dividend distribution tax, which experts say will reduce investor returns.
The thought is perhaps there is going to be no pass-through on DDT and the MAT continues to stay. Now, if this is what the impact is going to be, the net return to the retail investor is going to get suppressed.
Now, I'm not really sure if that sort of an interest, that sort of a return on that investment will entice some of the retail investors in India.
An active Indian REITs market is expected to realize over $12 billion in investments over the next few years. But now, some of these developers are deferring their plans while they wait for more clarity on REITs.
In the absence of clarity, I don't think people will be in a hurry to start the work on this front. At least from prestige point of view, we want to have all the loose ends done and then clarity to emerge before we start work and then go ahead with our REIT listing.
As a business plan, I think we are ready, but when will we get full clarity on the regulatory framework is yet to come.
The sector is talking to the government to have these issues addressed when the parliament debates and passes the finance bill. But there are slim chances of any positive change. Sources tell NDTV that several developers are in active talks with investors and distributors to figure out how they can make REITs work in its current form. As a result, experts are still hopeful that the first Indian REITs may list this year.
Senses that some of the very large owners, including some institutional owners like a Blackstone or a DLF or a Keraija Corp, they have a pretty sizable portfolio amongst themselves. On average, these would be having 30 to 50 million square feet. The plans are afoot to get a REIT listed by some of these owners of assets.
I am very hopeful that within the financial year 2015-16, there will be at least one, if not two REITs that will happen. I'm certainly very hopeful.
Now the only question is which company will make the first move, and will the government take that extra step to ensure REITs is a success? From Mumbai, Nikhil Narayan Sivadas, NDTV.